All right, welcome to the Multifamily Investor Nation weekly webinar. I am your host, Dan Hanford, and also we have with us a special guest, Scott Maurer with Advanta IRA, and we're going to have him be presenting today on this topic on using your self-directed retirement accounts for investing in multifamily syndication. And so if you look on your screen right now, I have the page that you went to register for the webinar. Just to recap what we're going to learn today, we're going to be talking about self-directed retirement accounts and if it's actually legal to self-direct them instead of going through some other type of custodian like a Charles Schwab or Fidelity or those types of groups. And then what types of retirement accounts are able to be self-directed. And we're going to talk about how you can use your self-directed account to invest inside apartment syndications, what types of investments are not permitted, because not all types of investments are allowed to be put into a self-directed retirement account. So we'll cover some of those today. We'll also talk about a common conversation that I hear from some of our investors, that their financial advisors say that these are a scam or that they're unsafe or various things like that. So we'll touch on that today as well. And then for those of you who are active syndicators putting deals together, we're going to talk about how you can actually accept these self-directed retirement account funds for people to invest inside of your next multifamily syndication. And of course, like Scott always does, he's going to provide more and more information along each one of those things throughout the presentation. For those of you who have just joined us, I'll tell you a little bit about myself. I'm one of the managing partners with PassiveInvesting.com, and we acquire large Class B apartment complexes. We've now reset our criteria moving forward into 2020, minimum 20 million in acquisition, minimum 200 units, and then stable blue chip markets. So if you're interested in learning more about what we do and in investing alongside us, whether it be with your retirement account or other cash that you have to invest, this is our website right here. You can find some more information about our group and what we do and some of the properties that we've acquired. You can also find more information about each one of our managing partners, myself, Dan Hanford, Danny Randazzo, and Brandon Abbott here. And on the top right-hand corner of every page, you'll see this little button that says the Join the Passive Investing Club. You can click on that and put in your information, and I will be glad to jump on a phone call with you to discuss any goals that you have for investing to see if our group would be a good fit for you. So feel free to do that and check that out. Our special guest today is actually with Advanta IRA, and I'm sure he will introduce himself as well as Advanta in a little bit more detail, so I will save that for him. But one last thing I wanted to mention to you is about the Multifamily Investor Nation Summit coming up. It's going to be coming up in January 2020, and so it's going to be January 16th, 17th, and 18th. It is a virtual, online, virtual online conference. None of the sessions will be pre-recorded. I mean, I'll have 50 plus speakers at the event. We've actually done this twice now, and there's a lot of information here about multifamily and how to invest in it. And even for those of you who might be passive investors, gives you a lot of deep dive into what to be looking for from various sponsors. So if you want to register for that, you can go to mfinsummit.com. It'll bring you to this sales page. Right now, it's not completely updated for all the speakers that'll be coming up. And if you register through that site right there, it'll probably charge you a little bit more. But if you register today, you can actually go to Next MFIN, go to nextmfin.com, and you can register for that summit right now for only $97. So that page will not be up for very long, but if you want to do that between now and the next couple of days, then be glad to be able to honor that price for you by going to nextmfin.com. So right now with us today, our special guest on this webinar and on this topic is Scott Maurer with Advanta IRA. And I'm going to go ahead and I'm going to go ahead and stop sharing my screen, Scott, so you can introduce yourself and start to share your screen and take it away with the presentation. And then I'll be on the background here to handle any questions as we get down towards the end. So Scott, thank you so much for taking some time out of your schedule and looking forward to the presentation today.
Well, great, Dan. I appreciate you having me on today, and hopefully the people who are listening and watching today will definitely come away with the answers to the questions you outlined already. I'll make sure we touch on that. Get into a couple more issues as well, but I'll encourage, kind of state it now, I'll say it again at the end. When it comes down to your individual situation, whether you're a syndicator, whether you're looking to invest in syndications, sometimes the best way to get your specific question answered is to reach out to me as well, and all my contact information will be here as well. So just keep that in mind. I'm happy to take questions here at the end, but if you have something very specific you want to talk about, please reach out to me on an individual basis. I'm more than happy to share my time talking with you. So my background, by degree, I'm an attorney. I do not practice law, though, for our Advanta clients and people that we talk to on the Advanta side. I do some legal work outside of our company, but my main focus on a day-to-day basis is really the business development of our company. I've been with the company since 2006. During that time, I've worked with countless individuals who are looking to invest their retirement funds into primarily real estate assets. We see a couple of different other unique investments as well, but most of what we see is real estate based. So I've helped people not only from the standpoint of starting up their accounts and getting invested, but I've also worked with a lot of referral partners as well, talking with them on exactly how we can assist them, how we can help them, and be a good partner. So that's something I definitely wanted to touch on during the presentation today. So I'm kind of talking to maybe two audiences, or maybe some of you are syndicators, but you also invest passively as well today. So please just keep that in mind as we go through the presentation. One quick disclaimer: everybody has to. It says a legal disclaimer. We're no different. But at Advanta IRA, and I'll talk more about what we do specifically in the text in the course of the presentation. But we don't give any legal, tax, or investment advice. So we are not an investment advisory firm telling people they should or should not make a particular investment. We're not evaluating an investment either from a suitability standpoint, which I think is advantageous to some extent for people who are syndicating and you're looking to raise capitals. We're not going to throw up a roadblock and for someone who already has committed or wants to invest with you. So in the course of what we do, we discuss a lot of legal issues. We discuss some tax issues, things we'll touch on today as well. But when it comes down to making a decision regarding an account from a legal, tax, or again, an investment perspective, we do have to defer to other professionals in that regard. And we certainly have referrals of people that we can send to you. Just a quick background on our company. Been around for over 15 years. We have over $1 billion in assets under management. We have two primary offices. One is in the Tampa Bay area. One is in Atlanta. We do a lot of educational events, and what our kind of big thing we like to push at Advanta is our customer service. We get compliments all the time from people that we meet regarding how we handle our clients, the reaction times from our account managers, and we pair every single new client and referral partner as well with one account manager here at Advanta, someone who's going to be your point of contact, and that's been proved very successful. We get reviews and rave reviews from our clients all the time, and again, referral partners as well on how that works out for them. So we really focus on our customer service and then also our education. I'm very happy to be Dan's invitation coming on the day to talk to you on his platform. We do a lot of events on our own platform as well. We've had Dan before himself on our platform and intend to have him again here in the next month or two as well. But we try to bring a value to our clients and even prospective clients by making sure people are educated about what they're doing. And that could be just, an event could be just me talking about what we do and some different aspects of self-directed IRAs. Like I said, we've had Dan on before, so we like to bring experts in certain industries and professions as well. So again, customer service and education is really what we focus on at Advanta IRA. So some of you on the call, I'm sure many of you on the call may have heard of self-directed IRAs before, but there's probably a few of you at least that haven't, or maybe this is something that's fairly new to you as a concept. And a lot of people, even the ones who've heard about us and come to meet with us, will eventually someone will ask, why haven't I heard about this before? Or I wish I'd heard about this, years before. So they're always kind of wondering, why is this concept? Why am I not hearing about it from other places? And the reality is that most IRA accounts, are with a bank, with a brokerage firm who offers you limited investment products. So they sell mutual funds, they sell stocks, bonds. That's their business model. So they don't really have a vested interest in telling their clients, hey, if you want, you can take some of your funds from an IRA account and rather invest with me in buying another annuity or buying a mutual fund, you could invest in a private placement, real estate syndication deal. Because if you want to take that opportunity, you have to pull your money away from them. So a lot of investment advisors and companies are certainly not going to advertise this to their clients. I will say some of them even go so far at times to try to scare their clients away from it. It's one of the points that Dan brought up that we would talk about When an investment advisor says, a real estate IRA or a self-directed IRA is a scam or it's an awful idea, a lot of times it comes from either their ignorance of the topic, and they're not really, because they're not brought up in this world to realize there's other investments that you can make besides mutual funds and stocks. And so anything other than that, they're scared of. And you have the people who just simply don't want to lose that client base and don't want a client to take a portion of their portfolio and move it to something outside their control. They're not going to get paid anymore on that particular account. So the reason why, again, most people haven't heard of self-directed IRAs is simply they're not going to be told by their existing broker, their existing IRA account custodian, hey, did you know there's other options out there? I liken it to fast food. If you went to McDonald's today for lunch, they're not going to talk to you when you go up to the counter about having tacos today for lunch. Or wouldn't you rather have pizza, because you might pique your interest and you leave. Same thing when the IRA world. So the thing, though, that a lot of people don't understand is IRS regulations allow for a very, very broad range of different types of investments. We're going to go over in a few minutes a few things you can't do with a self-directed IRA. But IRS regulations allow for so many different types of investments. We can't even make a complete list of them. However, the IRS does not require each custodian to hold every asset. So even though you can buy a single-family rental property, or you can invest in a note and mortgage, you can invest in a multifamily piece of real estate, IRS says not every custodian has to hold that asset. So companies like Schwab, Fidelity, Morgan Stanley, Merrill Lynch, they don't want to hold a real estate investment inside of their IRAs, and they're allowed to tell their clients simply that we don't do that. And that's where we at Advanta really fill that void and fill that niche in the market, where we are willing to hold the alternative assets, the things that those brokerage firms don't want to hold, we can hold inside the IRA and help keep it tax protected. So just some basic retirement plan facts. I think it's some of these numbers might be a little out of date, but they're fairly accurate. Currently, there's over $9 trillion in just IRAs alone, not even talking about 401ks, 403b plans that people have through their employers, but just IRAs alone. There's over $9 trillion in those funds. And roughly 4% of IRA funds are invested in something that would basically be considered self-directed in real estate or private equity and whatnot. So 4% out of $9 trillion is being self-directed. My guess is not that 96% of IRA holders are satisfied or happy with their investments. It's, again, simply that they don't even know this is an option. And it's especially something that's important when we go to talk about raising capital for your own syndication. Again, the fact that most people don't know this is an option. When you throw in the 401ks, defined benefit plans, the 403bs, the TSP plans that people have, that is another 15 or 16 trillion dollars on top of the 9 trillion in IRAs alone. So a lot of that money, again, also can be used, for capital for new investment. So a couple of things on IRAs: you can't take funds out prior to age 59 and a half without a penalty. But what we're talking about here, and what we'll get into in more detail as we go along today, is not pulling your money out of the IRA personally and then using the resulting cash to invest in real estate. That would incur penalties and taxes, especially if you're under 59 and a half. What we're talking about is using the money within the IRA, keeping it tax protected to make the investment, and then also have all of your gains coming back to the IRA on a tax-deferred or tax-free basis as well. So again, going back to the financial advisor, I've had people, again, tell me my financial advisor told me if I wanted to invest in real estate with my IRA, it was going to cost me a 10% penalty, as well as all of the income tax. And again, that advisor just simply didn't realize what the client is actually looking to do, which is simply keep the money within the IRA umbrella and keep it protected, and then actually making that particular investment. That's, again, what we facilitate at Advanta IRA. So kind of one thing, I guess, over the years I've learned, in talking with countless clients is, the different reasons why people choose to self-direct. Usually people are falling into one or more of these buckets. For some clients, especially people, I would say, in the real estate investor community, it's simply a new source of capital for them. So, for someone who already is investing in real estate syndications, they're already putting in 50 grand or 100 grand of savings accounts or other cash that they have into a syndication. When another deal comes along, For them, the IRA is simply a different bag of money, a different place to use cash in order to take advantage of that investment opportunity. So for some clients, it's, I don't want to touch my savings account for this one. I'll just use my IRA funds. And then they choose to make that investment. For others, it's the tax benefits. When you invest and reinvest with inside of an IRA account, in many cases, there's no tax consequence due whatsoever, as long as all of the gains are coming back inside of the IRA. So if you have somebody who is in a high income tax bracket now as an individual, they may not want to invest in in a syndication or an investment that's spitting off 10, 15% returns, because that income is going to be received by them on an individual basis and subject potentially to higher tax brackets, depending on how it's characterized. So making the investment instead of an IRA keeps it out of their tax base for that particular year. So again, some of these reasons are not all exclusive. And I'd say one of the other most common reasons we see, simply stock market fatigue. We're seeing now in the last few weeks with talks, everything going on in Washington and around the world, you'll see the stock market go up and down one day to the next. People get tired of that. They get tired of waking up in the night or turning on the news and seeing, oh, the stock market took a dive today, or the stock market's back up today. And it's affecting their retirement account. They have no control over it. So it's frustrating for a lot of people that when they see a real estate opportunity or some other investment opportunity that they know that makes more sense to them and gets them out of the stock market, it becomes that much more attractive as well. And it's really interesting, I would say, over the course of my time in Atlanta and meeting with people, you see anything from the public school employee who worked, in the teacher or as administration for years, to people who worked in the postal service and doing a TSP plan, all the way up to doctors and lawyers and other professions who just want to do, kind of that sexy investment inside their IRA account they can talk about at a cocktail party, and say what they're getting. So it really includes such a broad variety of individuals who choose to self-direct. All of them, the common theme, though, again, looking to do a little bit something different in their IRA and are coming across other opportunities to do it. All right, so when we talk about self-direction, it's important to know what types of plans can be self-directed. And very quickly, any type of IRA, whether it's a traditional or Roth account, a SEP or a simple account, any type of IRA can be self-directed, can be moved into an account with Advanta and then used to buy the different assets we're going to talk about today. So if an account is designated as an IRA, you can no doubt self-direct it. Now, traditional and Roths are typically for more individual accounts. The SEPs and the simples are more, we see those more with people who are sole proprietors who own their own businesses as well. The difference between a SEP and a simple and a traditional IRA is simply you can contribute more in a given year with the simple or the SEP. The Roth IRA is the kind of the shining star of the retirement plan industry. It is a tax-free entity. The returns and gains to a Roth are tax-free. When you take distributions in your retirement age, they come out to you tax-free as well. And I can go into more details again on an individual basis on the types of an account. So the other account that I wanted to highlight on the screen is the individual 401k slash the solo K slash QRP plan that you can have. That is a plan for people who are sole proprietors. If you own your own business or if you have a side business that you operate, it gives you the ability to contribute a lot more money into your account each year, like the SEP and the simple. But it also has some other tax benefits. We're going to talk about a kind of a little-known tax in the retirement plan industry towards the end of the presentation. But solo 401ks and QRP plans are not subject to that tax that the IRAs might be, depending on how an investment is structured. Other types of plans, a doctor or lawyer has a defined benefit plan. You can self-direct that. And any former 401k, 403b, 457, the TSP plans, all of those employer-sponsored retirement plans, once somebody no longer works with that employer, they can roll that money into a traditional IRA and then in turn self-direct. And that's where you see a lot of IRAs that people say, how do you get $100,000, $200,000, $500,000 inside of an IRA if you're only able to contribute $5,000 a year or so? Where that money is coming from are these old employer plans where people do contribute a great deal more on a given year. And once they retire, they quit, they get fired, what have you, when they leave that employer, they can move that money to a traditional IRA. And there are a lot of people, again, out there, again, talking to those here on the call that are looking to raise capital. A lot of people leave their money when they leave an employer, say they're changing jobs, or they quit, or they're fired, or whatever. They kind of forget about that plan. It's kind of on the back burner. All they think about is, getting their next job, getting settled in. They have that old 401k just sitting there, doing nothing, that they're looking to use and possibly put into place. Again, if you're raising capital, definitely something you want to keep in mind. So moving money to self-directed IRAs. So you have a 401k, you have an IRA account, and you've identified a real estate investment you want to make. How is that process handled? It's typically done one of two ways. It's either moving money via transfer or moving money through a direct rollover. And the terminology really, it depends on what type of current account somebody has. So if you're looking to invest in a real estate syndication with your IRA at Fidelity, then you would do a trustee-to-trustee transfer of the money, where we request the funds from Fidelity to be transferred to your Advana account, moved into that account, and then from there you tell us what you want to invest in. If you have an old 401k or 403b plan from an old employer, you will request a direct rollover from them to move the money into to the IRA account with us to then invest. Again, you don't have to memorize the different ways and different types. We will guide, we guide people through that process. Just know that whenever someone moves money from a one IRA or a 401k to a self-directed account, there are no taxes, no tax consequence whatsoever. It can be done in partial amounts. They don't have to move their entire nest egg from one account to the other. They can move over to us just what they need in order to self-direct. So that's kind of, again, important thing to note, because, again, sometimes financial advisors, I've even seen CPAs as well, get confused on this issue. Again, when you tell your financial advisor, I want to move money from this IRA account that I have with you so I can buy some real estate with Advana, that advisor thinks you're pulling the money out on an individual basis, subject to tax. But in reality, what you're doing is doing a trustee-to-trustee transfer where the money never touches your hands, and therefore it's not taxable to you in order to move the money in that fashion. Again, we walk each client, every individual through that process when it's time. So we've covered the types of accounts you can self-direct, the ways to move the money over, either a transfer or rollover. Then ultimately, once you have the account established, the self-directed IRA, it's up to you as the account holder to then decide what investment you wish to make inside the IRA account. I mentioned probably 75 to 80% of the investments we hold at Advana are real estate related. And that could be anything from a single family home that's being used as a long-term or short-term rental. Maybe you're flipping a property, private notes and mortgages, mobile home parks, tax liens. But again, what we're focusing on today is you can also, and people can invest in, private placements, whether it's a commercial, development or just a multifamily syndication. So some of our clients, they want to go out and buy a property in their neighborhood that they can just rent out to a tenant and be much more hands-on and involved that way, which again is going to take a little bit more of their time. But we have a large other segment of individuals who want to invest in real estate. They see that there's opportunities out there, but they don't have the time themselves to go out and identify a property, deal with the tenants, deal with the toilets, but rather would invest with somebody else who's going to handle that. And that's where multifamily syndications are very attractive for those groups of investors, because they can still get a fantastic return to their IRA, get their money out of the stock market, but better yet, somebody else is actually going to manage that particular asset for them. They just have to sit back and get that check each month. So the common thread, again, with these types of assets, brokerage firms won't hold them. Okay, so every now and then you might find a brokerage firm that will make an exception here and there for a client, but on the whole, 99% of the time, the brokerage firms and banks do not want to hold these assets in their portfolio. One of the things the IRA custodian has to do on an annual basis is submit a valuation to the IRS for each IRA that they hold. And for a brokerage firm, it's easier to punch the button on December 31st or whatever your stock and mutual fund closed at to report that value. With real estate, obviously there's a little bit more work involved, and that's what we're accustomed to doing to report that value. But that's one of the reasons the brokerage firms don't want to hold the asset. As we'll go through one case study here today as well, they also don't want to be involved in receiving income, paying bills, and whatnot related to those assets as well. So I mentioned in the beginning the IRS regulations allow for a very, very broad range of investments. I said we couldn't even list them all because they're so numerous. And the reason is because when the IRA, when IRS and the rules were set up for what you can do or can't do within within an IRA account, the IRS chose simply to say, you know what, rather than try to anticipate all of the potential investments that someone could make in an IRA, let's instead list what is not going to be allowed. And so the only two investments that the IRS says you cannot make in a retirement account is you cannot buy life insurance and you cannot buy collectibles like antiques, vintage, artwork, vintage alcohol, rare stamps, rare coins, things of that nature are the two types of investments that are prohibited. So they don't say that you can buy real estate or that you can buy into a syndication or that you can buy mutual funds or stocks. Simply, you can't buy life insurance and you can't buy collectibles. But so we don't talk much with people about that on a daily basis. That's pretty self-explanatory. It doesn't really come up much in the conversation. So one thing though, the other restrictions though the IRS has placed on IRAs is dealing with certain disqualified persons or having disqualified persons who may benefit on an individual basis from the investment held inside an IRA. And this is where we do get into many more discussions with individuals and something that will affect a little bit what we talk about today as well. So before we go into what you can and can't do with disqualified persons, let's define disqualified persons. That's for your IRA account. So if it's your IRA, your 401k that we're talking about, the disqualified persons to deal with your IRA include you and your spouse, your parents and grandparents, your children and grandchildren, your son-in-laws and daughter-in-laws, and then any business or entity that is owned or controlled by one of those individuals as well. So it's important to remember when we talk about self-directed IRAs that your IRA is its own separate legal and distinct entity from yourself as an individual. So your IRA as its own entity cannot transact with you or your spouse and cannot benefit you and your spouse as well for your investments. So what does that mean when it comes to real estate? If you own a property personally, you cannot sell it to your IRA account, or your IRA owns real estate, it cannot sell it to somebody who's disqualified. So any existing assets that are already owned are off limits to the IRA account. The IRA cannot lend to any disqualified person. So my IRA cannot simply loan my son money, cannot loan money to myself. And vice versa. Again, I cannot loan money to my IRA account. Again, when it comes to real estate, you cannot buy a piece of property that you want to live in, that you want to vacation in, or that you want to manage as well and receive compensation for. So when we talk about syndications, if you're looking at starting a syndication and you're going to be raising capital from a number of investors, no disqualified person should be investing with you through their IRA account. So if I'm starting a syndication, I cannot invest my own IRA into that plan or into that syndication. I cannot take money from my mom's IRA or my dad's IRA or my kids' IRAs. They're all also disqualified from investing with me because I'm going to personally be taking some type of management salary or compensation for that particular syndication. So no disqualified person can perform any work on that real estate or on that particular syndication. So again, the restrictions the IRS has laid out, no life insurance and collectibles, that's easy. It's also the dealings with disqualified persons though that pop up again, especially when we're talking about syndications and who you may be able to raise capital from. Now just remember though, siblings, aunts and uncles, cousins are not disqualified persons. So we've had a lot of people who have had their brother or sister invest with them. Yet as long as you're treating them as you are any other investor, there's no restriction on doing that. So again, the IRS didn't say, here's all of the impossible investments you can make inside your IRA. They said, here's simply the restrictions on what you can't do with your particular account. So we'll talk now, I'm gonna go through two case studies and then kind of, again, wrap up a little bit with about how we can help people who raise capital. But each case study, we're gonna talk, use the same individual. John's got money in an old 401k IRA account, wants to buy real estate. You know, obviously when you talk to someone about investing in real estate, it can be any number of things. So John could invest in the rentals and rehabs, lend money, invest in syndications, etc. He transfers $200,000 from his brokerage account to Advana, so he has control over the fund. So again, just illustrating there that when someone's looking to invest in a self-directed IRA, it does not have to be their entire portfolio coming over from their other custodian. They can just use whatever amount they need for the investment. Now, again, when an IRA makes an investment, whether it's a mutual fund or a piece of real estate, all of the income that asset generates must come back into the IRA. Any expense related to that investment must get paid out. And that's what we do at Advana as the administrator, is receive and deposit the income and pay the bills at the direction of the client, in this case, John. So just to kind of contrast, it's kind of two of the more common investments we see. Just want to show a quick case study of what a single-family rental home works for, just kind of illustrate what the process is on our end, and we'll talk about multifamily as well. So John, if he's looking to buy a single-family rental property, he needs to obtain the paperwork from us to open up the account. We'll assist him with that, and then also assist him with getting that money moved from his IRA, his old 401k, obviously, into the new self-directed account. When he goes to buy the single-family home, again, John is going to be in complete control of deciding, what property I'm buying, what I'm buying it for. Do I want this property to be turnkey? Do I want it to be, require a little maintenance and repairs before I can rent it? And again, the single-family home, in a sense, some people like the fact that they're in complete control. It's one property, one tenant that they're dealing with. They have their hands on most of that activity, and being able to direct that and have, again, it's the control aspect, I think, for a lot of people with single-family homes. All of the gain is theirs back into their IRA. No other partners, no other investors involved, unless John wanted to partner up with somebody else. He could certainly do so. But again, he's going to find the property to rent. He needs to find it. Again, I mentioned at the beginning, Advanta does not do due diligence on investments. So he has to locate the property, decide what he wants to buy it for. We will work with him to make sure it gets titled properly in the name of his IRA. That's, again, one of our roles at Advanta, not only getting the account set up and established, is getting it titled correctly. Then John, reviews and approves the closing documents. Ultimately, at the end of the day, the accrued rents are basically what is driving the gain inside of his IRA account. So the net rents at the end of each month simply flow back into his IRA. And again, what we do at Advanta, receive the rents and deposit them, and also pay any bills as well. So just to reiterate again, in the single-family home situation, the IRA is going to have to pay for all repairs and expenses, and then all the sales and rent proceeds have to come back in there as well. So John, with a single-family home, needs to find his tenants, needs to find his contractors, make sure he doesn't do anything that's prohibited. Just make sure, obviously he can hire a property manager, find somebody else to help him out there, or he simply could find something more passive if it gets to be too much. So again, we have clients who want to do all this work and don't mind doing a lot of the work, but a lot of other clients are looking for a more passive deal. And I think that's where we see a lot of individuals who come to us looking to do either private placement or a syndication, where they can be more hands-off. So in this particular situation, if John decides to go that route instead, John's going to have to find the deal. So in this situation, he meets Randy. Randy has an apartment complex that he's going to be buying and remodeling, and he's formed a syndication in order to raise capital to buy that and then complex, get it remodeled, and obviously then hopefully get it leased out. Syndications, those subscription documents, the prospectus that's involved, John's going to need to review that. So again, we don't do the due diligence for these investments. So John needs to read the subscription paperwork, the prospectus, be satisfied with what the outlines are, what the returns are going to be, and really determine if it's suitable for him and ultimately for his IRA account. In this case, investing in the multifamily, he doesn't have to find the tenants. He doesn't have to deal with the maintenance. It's just a passive. He's a limited partner in that particular syndication. So there's going to be a general partner, some other individual doing the day-to-day work of, the liaison to the contractors, hiring the contractors, getting the property leased, et cetera. He can sit back just as a limited partner and participate in the returns without having to do all of that work. I have one of our clients here at Advanta who has, I think, probably 6, 7 of these different investments inside his own IRA account. He calls it mailbox money. At the end of every month, he just goes to the mailbox, makes sure the check's there, sends it to us to deposit into his IRA account. He doesn't have to worry about anything other than on the first of the month, making sure that check is coming in, or it can be each quarter. It depends on how that investment's paying out. So again, our role at Advana, it will be to make sure those subscription documents show the name of his IRA as a subscriber. So with a single family home, we're working with John on the contract and on the real estate closing documents, and working with the title company involved with that. When it's a syndication deal, we're looking more at the subscription paperwork. So if you're looking to get investors into your particular syndication, we'll work with you as well to make sure that all of your investors, we get the subscription agreements complete how you want them done, how your attorneys are telling them they need to be done. The subscriber's name is the IRA account, and the tax ID number that's used is our trust tax ID number as well, not the social for John. We want all the reporting for the syndication to come back to our trust tax ID number, not to John's social. Once John's approved of it, we'll sign the documents on his behalf, we'll send the money to fund the investment, and then any future dividends, the profits, whether it's each month or each quarter that those are sent, all come back into his IRA. The gains that are coming back to the IRA are not included in his personal income at all. And so once his IRA exits the investment, all the other proceeds will come back as well to his particular IRA. So the syndication, our role in this process is really to facilitate John moving his IRA from his brokerage firm over to us, and then ultimately into the syndication itself, walking him through each step of the way, working with the people he's investing with as well, to make sure the documents get completed properly, make sure the money is following the right trail to keep the investment underneath his IRA umbrella. So we do a lot of work up front with the investment partners who are putting together the syndication, so we all are on the same page as well with what paperwork, what documents are going to be required. Did want to touch on one thing though that comes up a lot of times in syndications and sometimes other types of leverage investments, and that's unrelated debt financed income tax. So UDFI, some people call it UBIT. Now, for the most part, when an IRA makes an investment, and say it pays cash for a single family home, the income that it receives, not subject to any tax whatsoever. Or if an IRA invests into a large partnership where there's no debt involved, again, all of the income comes back to the IRA with no tax consequence. But if an IRA is a part owner in a deal where there is some leverage involved, the IRA, the return it gets, can be subject to this particular tax. Typically, the tax is levied only on the portion of the income that is related to the percentage of leverage as well. So if a property is 70% debt financed, then that means 70% of the income that an IRA receives is going to be subject to this UDFI tax. It's a tax that is assessed at trust tax rates. The IRA itself files a form and pays any tax that might result from that particular impact of that tax. Now, if you have UDFI considerations for your IRA investment, because your IRA is invested into a project with leverage, your IRA does get to take deductions for depreciation and other write-offs that would limit how much tax would actually apply. So that's, again, something to consider if you're looking to invest in a deal, is the impact of the UDFI tax. Now, one important thing I like to point out, this does not make your investment prohibited. It just means that your IRA might have this tax that will result if you make that particular investment into a leverage deal. So to check your particular deal and make sure what's involved, and obviously what you're getting into with an IRA. Now, one important note for those of you who are self-employed, or you own your own business, or you have a side business and can set up a solo 401k or QRP account, 401ks and QRPs do not pay UDFI tax on that type of income. So one person uses their IRA to make an investment into a leveraged asset. That IRA might be subject to UDFI tax. The 401k will not be subject to that at all. And so that's one of the big reasons when people are looking to do syndications or looking for investors, if somebody can qualify for a solo 401k or QRP plan, it makes so much more sense to make that investment through that type of vehicle than an IRA. IRAs can still be great, depending on how you structure it. There are ways to structure your particular partnership or syndication. What they call it a UBIT blocker or UDFI blocker. That's a question to talk with your attorney about how that works. There are ways to structure as well your investment so that even IRAs don't pay that particular tax. That's why I always say UDFI might apply, because I don't know how each of the investments our clients are making is structured. That's a question more for the investment provider. So again, for a solo 401k or QRP though, this tax does not apply. And all you need in order to have one of those is either be self-employed or have a side business where you derive a little bit of earned income that would allow you to establish that type of solo 401k plan. All right, so kind of gone over a lot of the things today from the investor perspective, at least with the case study as well, showing how that works. But spend the last minute or two here talking about from the syndicator side, why are self-directed IRAs a good capital source? Why should I, if I'm starting a syndication, focus and at least make self-directed IRAs part of my capital raising strategies? I think 4 of the big reasons are on this screen here. For one, you get repeat investors. So people who've already invested with you and know what kind of returns that they're getting and can expect, again, don't realize that they could use their IRA to even invest with you. That's an easy sell if you're already producing on their individual investment. Say, hey, I can do this for you inside of your IRA as well. We can get your money out of the stock market and earning the same type of return that you're getting personally. The added benefit, though, that potentially there's no taxes due whatsoever on that money coming back into your IRA. We had, on a side note, a company a couple of years ago that was raising money for its capital raise in a private, basically selling private stock. They mentioned all they did was simply go out to their existing investor base who'd made up the bulk, the majority of their capital raise on their first round of funding. When they went for that second round of funding, they included a note about using their IRA account and were able to attract millions more in capital just from telling their existing investors how they could use their IRA to make that investment. For some, I think another reason why is people are not usually looking to use their IRA money anytime soon. So if you're talking to any potential investor and you're looking to raise 25, 50, 100 grand from them, if they might have some of that money in a savings account put away, but that's their rainy day fund. That's their money that if they were to lose their job or have a major medical emergency, that's what that money is there for. It's to be used at a moment's notice if need be. A lot of people will not touch their IRAs or 401ks until they reach retirement age. That's the last place they're going to pull money from because they know they're subject to taxes and potential penalties for just pulling the money out. So if you're looking for a syndication deal where you might be locking up somebody's money for 5 years or maybe even 10 years, they might make that investment inside their IRA. As long as you're going to produce that rate of return, they weren't planning on touching that money anyway. They might be more likely to invest their IRA funds rather than just their individual capital. Certainly, hopefully you're offering better returns than the money that's sitting in a CD or money market. Again, where a lot of people who are afraid of the stock market pull their money out and put it into a money market account just to keep it out of the ups and downs of the stock market. And again, I think one of the more important things, especially, is there's no outside approval needed. So if you were talking to an investor and sell them on investing with you, they do not need to get special approval from a bank. You do not need to get special approval from a bank. It is simply the IRA owner deciding that's what they want to do. Again, our role at Advanta is not to evaluate your investment. It's not to make the client think twice about making the investment. Ours is simply to process the investment and make sure things are titled correctly. So when you send us an investor, our role is simply to say, hey, what questions do you have on the process? Let's get it going, and helping them fill out the paperwork. So we're not going to put any roadblocks up for that. And kind of, so I guess why people work with us. I'll show you an example of a partner page in a minute, what we can do for you to help you attract investors. But there's no lengthy approval process on the paperwork. If you're doing a syndication, you send us the subscription documents. All we want to do is know how you want it completed. We're not going to send it to a legal department for a few months and then get back to you. It's simply client wants to invest. You have a subscription agreement. We're going to facilitate that. We work with for years with different private placements. We put people together again with private account managers as well to make sure that they have that streamlined process. Everything is easy frankly, for everyone. For us as the administrator, if you have multiple people that you're sending to us, we want that process to be easy on our staff, make it easy on your investor, and certainly make it easy on you as well. We do flat administrative fees. We don't charge commissions or percentages of return as well. And we utilize DocuSign a lot for getting a lot of the paperwork done. I mentioned one thing we can do for people who are looking to raise capital. We are not permitted to solicit our clients or prospective clients for an investment. Say, hey, I think you should go invest with John, or you should go invest with Randy with your IRA. But what we can do is provide you with, we call it a landing page, basically a private landing page where we use your name, your company's name, your information, and give you a link that you can then share with your potential investors, or through email, put it on your website, or hopefully you can attract people and let them know that they could use their IRA or old 401k to invest with you. So we provide these partner pages free of charge. You can just contact me after the seminar. I'll let you know what we need in order to get that done, and then give that to you. And in addition to this landing page, we can also do a PDF flyer that looks very similar, kind of that outlines what steps to take if you're looking to invest your IRA with ABC Capital, and provide that to you. It's something we provide free of charge to you, so that hopefully then obviously you'll share it with your investors who may need to use our particular service. So may have went a little bit over on time. I apologize for that, but here's my contact information on the screen. You can certainly reach out to me again if you have questions, or you want some more information on the landing page or the collateral, whether it's you and wanting your own account. I'm always happy to be there as a resource.
Well, thank you so much, Scott, for all this great information. I know we have a couple of questions that have already come in. So for those of you who have been watching the webinar and maybe have a question or two, find that Q&A box and type it in there, and I'll queue up these questions for you, Scott. First one's coming in from Chad. He's asking, and I think this is when you were talking about the various types of taxes that the IRA would get hit with as far as the UBIT and stuff. He's also asking about, what about the capital gains taxes that's inside of one of these self-directed accounts?
Yeah, so capital gains do not apply to IRA accounts. So when an IRA makes an investment, all of the income and gain comes back to the IRA on a tax-deferred or tax-free basis if we're talking about a Roth IRA. Again, sometimes there's the UBIT issue if there's leverage involved, but there is no capital gains due to an IRA. So the income comes back into the IRA, just begin and accrues there. Now, when people do get to retirement age and pull money out of an IRA, it's included in their ordinary income at that time for any account that's not a Roth. So potentially have a different tax rate than the capital gains rate, but that's probably, for a lot of people, that's down the line. Nothing's going to hit them this year with that investment.
Okay. Now, next question here is regarding donor advised funds and those types of accounts. Does your group work with donor advised funds and being able to self-direct those? And if not, do you know anybody who actually does? And does the UDFI apply to that too?
No, I don't know that we do work with those, and I'm not really sure where to send someone on that particular type of investment. So I apologize for that. I can't answer that one.
You got him. You stumped Scott on a question.
It's been a while, but it happened. It happened.
Next question's coming in from Casey. When is the UDFI tax paid? Is it annually or when the IRA comes to completion?
It is paid annually. So it's due. I think the tax return is due by June 30th, I believe, the 990T. So you calculate that on a calendar year basis, how much income the IRA has received, deduct your depreciation, take off other deductions. But it is a tax that's paid on an annual basis. And then again, it ends obviously whenever the investment ends as well. Once the investment closes out, there's obviously no more UDFI tax then, but it is paid on a yearly basis.
And it's typically on, say, for example, these apartment syndications, the depreciation that's taken off of that can offset that as well until you exit the property, and there might be recapture. Is that correct?
Correct. That's correct. Yep.
Okay. So some people might not actually, quote unquote, pay them every year. It's probably deferred until the actual property is sold. But if it's, instead of selling the asset or after it's sold, instead of taking that gain, they can just roll it over or 1031 into the next deal and continue to defer that. Is that correct? That's
correct. So yeah, with the UDFI, like I said, it's not up to us to make that determination. And we certainly have seen a lot of people who just don't even, you don't pay it year to year because you have that depreciation. The IRS also gives you, I think, $1,000 automatic deduction for it. And if you're not going to have any UDFI tax that is owed, or I think if it's less than $1,000 total in that income, you don't even have to file the 990T return. So it's not even, for some people, you don't even have to file the return every year if that depreciation is wiping out a lot of that gain.
Yeah, good. Next question is, excuse me, can my husband transfer money from his IRA to my self-directed account?
Unfortunately not. With IRAs are individual accounts. So you can't, husband and wife cannot move money between their two accounts. What you can do, though, is say if a husband and wife have enough money collectively to make an investment, you can make an investment together using both of your IRA accounts, and then the income and expenses are split between your two IRAs. So it's not a matter of getting all the money into just simply one IRA to make the investment. You could actually use both IRAs to make that same investment.
That's something similar to what we do as well. You know, if we have a couple that has like our minimum investment on our properties is typically 50,000. But if a spouse wants to bring in 20 from one and 30 from another, you know, they can certainly pool those together to create that joint 50,000 as well.
Yep. Yeah. No, we see it done quite often with, say, husband and wives, maybe a brother, sister, someone like that. Even using your IRA funds and some personal cash as well to make that type of investment. You can do that partnering arrangement as long as you do it up front.
Correct. Now, are you located in the Atlanta office is what Don is asking as well?
That's a tricky question for me. The reality, okay, I live in Tampa, so I live in the Tampa Bay area, but I am in the Atlanta office once or twice a month overseeing some of the staff that's up there. So if someone's in Atlanta, I'm happy to schedule time to meet with you when I'm there, or you can also meet with Renika, who's there full-time in the sales department. So, but yeah, so technically I don't live there, but I am in that office quite often.
Another question here is coming from Ronak Shaw. He's saying, can my self-directed IRA co-invest with me in active business where I take compensation?
The answer is not really, because in that situation, you're using your IRA as a part investor. And if you personally are receiving compensation for an investment, then your IRA cannot make that investment. So that's one of those kind of tricky things. It's just not allowed. That's the IRS wants you to use your IRA really to benefit itself, to benefit you in retirement. They want you to grow your retirement account, and they give you the tax benefits so you can accrue that money, get to retirement age, and hopefully have a larger nest egg to live off of. That's why they put those rules in place, is they don't want people also being compensated now, because that's really not what IRAs were created for. So if you're investing personally with your IRA account, say on a passive basis, you personally can receive your portion of any income that's generated, but you can't really be paid any type of salary or management fees, because in that case, your IRA would then be paying you. So hopefully that answered that question. I'm happy to again go in more detail with Ronak after the call.
So I'll take one final question here because we do have to go. We have a hard cutoff here in a couple of minutes. But last question coming in here, Scott, is what are the criteria for being able to set up a solo 401k? Can you create one when you have an existing 401k with an employer?
You can. So if you have a 401k with your employer, you can also set up a solo 401k, but you would have to have like a basic, kind of like a side business or some other little enterprise that you're doing. I do think people out there get the misconception that they can just create a solo 401k for any reason, but the IRS really expects, if you're going to set up a solo K, that you have your own business, whether that is your full-time business or just a side business. But if it's a side business, you can create a solo K, make minimal contributions to it if you wish, to legitimize the 401k. The only restriction that if you have an employer's 401k along with your own solo 401k for your side business, you're just limited to the maximum contributions for both accounts. So you can't double dip there. But the main requirement really is that you have a legitimate business or side business to basically sponsor the 401k account.
Great. Well, I know several of you on here might have some additional questions that might be more, proper to be able to, reach out to Scott directly and answer some of those questions, or able to ask some of those questions. So hopefully you have jotted down his email there that's on the screen, as well as his phone number. He loves to be able to, jump on calls and kind of dive deep into your personal situation to see if Advanta might be a good fit for you. And if not, he'll tell you that and tell you what your next best option will be as well. If he's able to do that. So thank you again, Scott, for coming on to the webinar today, and looking forward to continuing to follow you and also having you on some of our future webinars in the future as well.
All right. Thanks, Dan. Look forward to it.
Thank you so much, Scott.